financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rayam. Hello.
Hi, Jess. How are you?
I'm good. What do we have on tap for this week?
Well, mortgage rates are through the roof. Well,
Mhm.
that's a bad combination of terms, I guess, but they are, bad pun. But there are ways to get a home with a really low mortgage rate still. And it's not a variable rate mortgage, but it's one that even many realtors aren't really aware of or maybe don't talk about very much. So I don't know if you've heard of it, an assumable mortgage.
I have not heard of it, but I'm going to assume it means taking over someone's mortgage. Is this kind of like a foreclosure, sort of?
It's not like a foreclosure at all, actually, but it does mean taking over somebody's mortgage. So we're going to go through the details here, but you can buy a house if it has an assumable mortgage on it and still get that same low rate. So if somebody got their mortgage at 2.49% and it's the right kind of mortgage and you qualify, you can take over that mortgage at 2.4% and still just fund the difference. We'll go through the math, but just to get an idea of what that means, let's see. So the kinds of mortgages that qualify are government-backed mortgages. So there'll be FHA, like Federal Housing Authority, USDA, United States Department of Agriculture, or the VA, the Veteran Affairs, right? So you're looking for mortgages that are like that. Now, there are several startup companies that are starting to put out lists of these mortgages so that you can go house shopping for a mortgage or go house shopping by looking at the mortgage rate and say, well, gee, there are houses in my area and I can get these mortgage rates and they're published. So I could go for this house at 2.49%, or I could go for that house at 4.06%.
But why would the homeowner want to do that unless you were giving them a lump sum payment for like the equity? Is it because the house is going to get taken away if they don't? Or what? Like, what's the incentive?
No, it's a built-in feature of the assumable mortgage. So why would a homeowner want to sell like that? Because
Yeah,
it's a sales tactic. If you're selling your house in this market, so that's a great question. Let's look at this logically, right? I have a house for sale and Jess wants to buy it. And in order for Jess to buy it, she's looking at a mortgage rate of what the current average is for a 30-year fixed rate mortgage right now is 7.09%.
Oh, it's terrible.
It's high, right? Now, it's not as high as it was when I remember when I first started, in real estate and flipping houses and started in the financial business in general in the late 80s. We were looking at mortgage interest rates, in the 80s were up to 18%. And that's when these assumable rate mortgages became really coveted. So I would actually look for homes that had assumable rate mortgages. I would look for an FHA home or a VA loan, right? Because the seller can use it as a perk. So if I want to sell my home and Jess wants to buy it, and she's looking at, say, a 7.09% mortgage, her mortgage payment on my home, let's say it's a $400,000 home, that might be about $2,500 a month. But if she can take over my assumable mortgage, right? Maybe I only owe 300,000 on the house and it's up for sale for 400,000, right? So that's your equity question. I have 100,000 in equity. So why would a seller want to do this? Well, I could say, Jess, I have an assumable mortgage at a 2.49% rate, which you can take over, and I still owe $300,000 on this house. So that would bring your payment down to about $1,700. I'm using rough figures here, but instead of $2,500 a month, you'd be paying maybe $1,700 a month. There's a couple little caveats we'll go into, but then you have to do something about the extra 100,000 I want. That's my equity, right?
Right.
But getting a second mortgage for 100,000, even if it's, say, a home equity line or something at 9%, it's still going to bring your payment down lower if the first mortgage is low enough, because you're basically borrowing 300,000 in this scenario at 2.49% and 100,000 at the higher rate, right? in our
But
little scenario. So
but
you'd still have a lower, go
wouldn't you have
ahead.
to come up with that 100,000 though before you could take over the house? Like that's I think where I
Sure.
would get caught is okay, yeah, you could take a second mortgage, but you're gonna have to give them that 100K ahead of time.
You're
They're not
absolutely
gonna let you
right.
take over. Yeah.
You're absolutely right. And that's the big stumbling block for people. And so even a lot of real estate agents don't know their way through this, mostly because they haven't been popular since the 80s.
Hmm.
But with rates where they are, this is a very attractive way if you can find one. And there were something like 12.2 million of these loans on the market last year. So they're out there. The 23% of the loans, I think, were assumable.
Hmm.
So they're out there. So, yes, you have to pay that 100,000. Now, how are you going to do it? Well, a lot of times people are putting 20% down on their homes already. So
Hmm.
let's take this $400,000 example again, not to get too
So you
deep
have
into
eight,
math,
you have
but
80,
that
80
means
grand there.
you put 80 grand down. So you only have a $20,000 gap. So to fill
Hmm.
that $20,000 gap, you go get a second mortgage. Now, it could be that you had to fill the whole gap. As long as the lender who gave the original seller the loan that you're going to assume
Hmm.
accept a second mortgage on the house, and they usually don't care because they're in the first loan position should you default, right? The second mortgage can be put on the house even for a much larger amount. So you can still get into one of these with a fairly low down payment and keep your payment low by assuming someone else's mortgage if it's an assumable loan.
Can you get the first and second mortgage at the same time that you're applying for the loan from the bank? Okay,
Yes.
so then you would have that money instantly to be able to give to them.
Yes. Now that's where it gets tricky for real estate people is, organizing that. First of all, you've got to coordinate with the lender. And remember, it's the seller's lender you have to go through because it's the seller's lender that's holding
Hmm.
that mortgage. So they have to approve you. So you have to qualify it, but it's not impossible to do. I mean, I don't mean to paint this as a difficult picture. If you qualify for another mortgage, you'd probably qualify for this assumable rate mortgage. So they're going to qualify you, but they're going to ask you at the same time, just as if you went for a traditional loan, well, Jess, how are you going to cover this other 100 grand? And you're going to
Hmm.
say, well, I'm going to put 10% down, 40,000 on a $400,000 house, and I still need another 60K to make this loan work. And so they'll say, yeah, okay, I think we can do the first mortgage as the assumable for 300,000. You're going to put down 40 grand as your down payment, and we're going to give you a second mortgage, or somebody else is going to give you a second mortgage for 60,000. Yes, for 60,000.
Yeah.
And then that gets coordinated and happens at a closing table just like any other traditional loan that might be done in what we call an 80-20 split in the past. You probably remember me
Hmm.
telling you that you might be able to get around private mortgage insurance by using an 80-20 split. In other words, an 80% first loan and a 20% second loan. Ridiculous as it seems, they don't count that as 100% loan to value, and so the first lender doesn't require your private mortgage insurance. Now, I've digressed a little bit here into another topic, but it brings me back to a point that with these assumable rate mortgages, you may have to pay private insurance. Now, on the FHA mortgage, you'll pay it every year. It's like 0.8%, I believe, and you'll pay it every year as long as you have that assumable FHA mortgage. But on a
Hmm.
VA loan, you pay 0.5% one time and no more fees. But there are caveats to these things. So, I love it when you ask questions because I know that you're, and no insult intended here, but you're a regular person. You're not a financial
Hmm.
person. And you
Yeah.
think like a regular person. And that's what we want to do is to help people in the general population understand what we're talking about, assumable mortgage. I mean, you're right. The first thing that came to mind is somebody getting foreclosed on? I can take over their mortgage. This isn't like, taking over the payments on a car that's about to be repoed.
Hmm.
It's not that at all. It's
Okay.
that somebody got a mortgage at a really great rate. And if it is an FHA, VA, or USDA mortgage, it probably has, this built-in assumable clause, which can turn out to be a great benefit. And we're talking not just to buyers here. Sellers have these mortgages and don't know it, don't remember that they
Well,
can get.
I would assume, and I could be wrong. Finish your sentence. Sorry. Go ahead. They
I
assume.
would no, it's okay. Just that they can get money out of their home, sometimes more than they would have gotten on the regular market because the interest rate is lower on that mortgage, and so somebody can afford it more easily.
No, it would seem to me that the banks would hate this because then people are going to get a lower rate and they're not going to make as much money charging this 7 point whatever percent, right?
I just love the way you ask questions. So I don't know if the banks hate it. They don't have much of a choice. If you have an assumable mortgage, it's assumable.
Mhm.
Somebody does have to qualify, but you inherently touch on the sticky point and you've done it again. If you have to go, I love that you do this. If you have to go to an assumable rate mortgage lender who wrote that mortgage in the beginning, right?
Right.
They're the one who gave, in our scenario, my lender, ABC Bank, gave me a loan 15 years ago at 2.49%. And I want to
Mhm.
sell my house to you. And I want you to assume my 2.49% mortgage. Now, here's where it gets tricky.
Okay.
My loan servicer is going to make less money, not
That's why
just
I
because
figured they're
of
not
interest.
advertising this.
Yeah, not just because of the interest rate. They're going to make less money having you assume my mortgage than they would if they sold you a new mortgage.
Mhm.
Okay. So it's not that they intentionally drag their feet, but these mortgages are usually slower to close. So where a traditional mortgage might take 30 to 45 days to close, an
Mhm.
assumable mortgage might take 45 to 90 days to close.
Okay.
Still can be done, but that means that some sellers don't want to use that assumable rate mortgage as part of their sale. So we're here to talk not just to buyers, but to sellers about this being a win-win situation. It's good for both sides. If you can just tolerate maybe an extra 15 or 30 days to close your loan, you may well get more money out of your house or get a better buyer or just get the thing sold when it might not be selling because of a high mortgage rate in this market.
Okay, I've got more questions and we're going to hear more about this coming up in the second half. Let's get your phone number.
Sure, it's 413-773-3333.
And you can visit hugyourmoney.com. We'll be back with much more with the Money Doctor, Dr. Francis Ram, right here on WHMP. Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Ram. We're talking about assumable mortgages.
We are. I actually was thinking of having a guest today and at the last minute they couldn't do it. And so this teaches you to never assume anything and be ready for something else. And oddly enough, assumable mortgages are kind of an untalked about topic, I think, or less known topic. And I think
Mhm.
they're really important right now. And I think if rates continue to stay high, we will see these become more popular as they were in the 80s, as we were talking about when rates were really high as 18% to get into a mortgage. So, we've had lots of questions about, should I buy a home now? Should I wait? What about the
Yeah.
market? Are mortgage rates going to go down? And we never have a crystal ball. We can say, well, I don't think they're going to continue to go up for long because they can't forever. People won't be able to buy homes, but yet the housing market is still,
Doing
hanging in
okay.
there.
Yeah.
Yeah. Yeah. So, it's going to take some time for this to shake out. If you've tried to get any work done on your home, if you've tried to hire a contractor, um,
Mhm.
you'll report that you can't even get 3 quotes these days because everybody is so backlogged and people are just happy that somebody showed up, you know?
Oh, look at I mean, just talking about the news recently, Jones Library in Amherst, they got one construction bid and it was, astronomical, but like one bid, you would think you'd get 10 or 12 for a big project like that. So you're completely right. Forget about trying to find somebody.
Yeah, and the scary part is that homeowners are just saying, and business people too, they're just saying, okay, do the work. When can you do it? And people are waiting 3, 4, 5, 6 months to get the work done, and they're paying
Mhm.
whatever they can,
Yeah.
whatever the people are asking because they can't get the work done.
Yeah.
I remember my favorite slogan on a truck that I ever saw on any sort of trade truck. I was in Florida where it really counted, I think. and I saw this plumbing company, local plumbing
Mhm.
company, and on the side of their truck, I kid you not, it said whatever the name of the plumbing service was, I don't remember, and their tagline was, "We show up."
They probably get a lot of business that way because people relate to that.
They probably did. It was years ago, and it always stuck in my head. Such and such a plumbing, we show up.
I was
Okay.
worried it was gonna be something like "We don't crack," and I was gonna tell you, "We're on the air. We're on the air."
Oh, that's
Poor
bad.
plumbers, poor plumbers. Pull your pants up. Okay, sorry. I digress.
Oh my gosh, the things we get into. Okay. So let's see. We're talking about buyers and sellers trying to
Mhm,
utilize the built-in benefit of assumable rate mortgages. And if you came
mhm,
into the show a little bit late, what that means is if you have a government-backed mortgage on a home that you're looking to buy or sell, and it's an FHA mortgage for Federal Housing Authority, it's a USDA, just like the guys who stamp your meat, right?
mhm,
Department of Agriculture, US Department of Agriculture, or a VA loan, Veteran of Foreign
mhm,
Affairs loan. If it's any of those three loans, it may, in fact, probably has this assumable clause built into the mortgage, and even sellers and their real estate agents often aren't aware of it. So if you're
mhm.
looking at a home, maybe one of your first questions should be, does this have an assumable rate mortgage? Because it's almost assuredly lower than the rates we have today.
Yeah, I was just gonna ask you, you had said in the first half that there was, a lot of lists that have all of these that are available. But I was gonna say, if you happen to be, just house hunting and looking at Zillow or wherever, you see a house that you think might not be able to afford the mortgage, can you ask the seller, do you have this assumable mortgage? And then I'm assuming you'd have to get the seller to agree to it, but is there any downside for the seller to agree to this?
Not really, except that people are afraid of what they don't know. And
Mhm.
so somebody will tell them, "Oh, your lender has to approve it and it's gonna take longer to close," and it's not as smooth as a cash deal, but what is, right?
Right. So maybe somebody who's got a house that's been sitting on the market for a while would consider this.
Maybe, especially if they owe quite a bit on it. Now,
Mhm.
this could be when we talk about a win-win situation, if you have an assumable rate mortgage and you owe $40,000 on your house, the person buying it isn't getting much bang for their buck by assuming that small mortgage if your house is a $300,000 house, right? Because they're going to have
Mhm.
to go get a traditional loan or cash for the rest of it.
Yeah.
But if you're in a situation where you have an assumable rate mortgage on your home, one of those FHA, VA, or USDA loans, then and you owe quite a bit. Let's say in that scenario we used where we had a $400,000 price on the home and a $300,000 loan that
Mhm.
still had that balance of 300,000. Then yeah, you might want to be thinking about this because the fact that someone can take over your $300,000 assumable rate mortgage and pay, maybe $500 less a month or even more, depending on what the purchase price and the rate of the house is. Even
Mhm.
if they have to make up a little gap with some cash down or a second mortgage, it's probably still going to be a far lower payment for the person buying it than
Right.
somebody taking a traditional loan. And what does that mean? That means you get your asking price or
Mhm.
maybe close to
Close
it,
to
or
it.
maybe even more than your asking price because they can afford the payment. This is the kind of thing I complain about on a daily basis about how people get, how Americans have, and maybe worldwide, have become uh, inured to the fact that as long as you can make the payment, it doesn't matter how much debt you're carrying.
Mhm.
You
Yeah.
know, so I'm not advising against this. I'm saying this is a good way for you to buy a home if you can make it work because that mortgage is assumable and it makes your payment affordable. I'd rather see you do that than, max yourself out completely because the housing prices are high and the mortgage rates are high and you have to go and buy that house at that rate and it's really a stretch for you. I'd rather see you assume a lower rate mortgage as part of the deal. And
Mhm.
there are lots of startups. This will tell you how this is starting to become popular again because they're out there, right? So there are
Mhm.
startup companies doing this. One of them is called Roam, ROAM, but there are several popping up, and this is like Zillow, right? So,
Mhm.
if you go to Zillow, if you've never gone to Zillow and you're listening to the show, type in ZILLOW and start looking for houses, you'll find, a litany. You'll find your own house if you own one, and it will just say it's off the market if it's not for
Right.
sale. So Oh, that's a whole different thing about how you should update your own house on Zillow if the stats are wrong. Let's say it says you have 3 bedrooms and you have 4,
Mhm.
claim the house and update it on Zillow. It will help you. Okay,
Okay.
that's an aside tip. Just pops into my head and has to get out there when I'm thinking of it. All right, so, Rome is a lot like Zillow, but it lists houses with assumable rate mortgages.
Mhm.
And just to give you some idea, I think last year, 6,000 of these loans went through last year, which was up 139% from 2022. And
Mhm.
this year already, as of May, when we're doing this show, this year already, almost 4,000 of these mortgages have gone through.
So
So,
that's all across the country though, right?
yep, yep.
So this is still not really well known, otherwise those numbers would be much higher.
Yes, but if you think about something increasing by 139% in a year,
That's
and
really
now
good.
it's
Yeah.
I mean, we're 2/3 of the way there already, and we're not even halfway through the year yet. These are
Mhm.
gonna happen. This is going to become more and more, appealing. So, companies like Rome, they don't do this for free or out of the goodness of their heart, right? They're making money on this.
Of course, yeah.
But it's, it's relatively low, I think. I think Rome, charges 1% of the purchase price of the house. So on a
Mhm.
$400,000 house, you're gonna pay them $4,000, but they help coordinate the thing you were worried about in the beginning. They help coordinate the deal with this
Mhm.
assumable rate mortgage, and they talk to the
So
lender and make it work. Yeah.
if you're someone listening to the show and you have a house that you're trying to sell and you just take a look after we talk about this and see you have an assumable mortgage, is there somewhere you can go to get your house added to these lists that you're talking about?
Well, that's a very good question. I would assume that you can contact Rome through their website.
That might help a seller if you include yourself in that list if you're finding. And also I know that there's probably a lot of people that just can't stomach how high the interest rate it is right now. So this might appeal to them because it's like you're still getting the house, but at the interest rate you want to pay.
Yes, exactly. I was trying to think of who that other company was. I don't remember the other companies' names, but I had a couple in mind, but there are so many popping up that you just do a search on Google for assumable
Mhm.
rate mortgage help or assumable rate mortgage company lists, and you'll find these lists. And they are similar to the REO list that we used to see in the 80s when the government was taking over mortgages and putting houses up for auction, and they would
Mhm.
list all the properties that were available there. They're similar to those kinds of lists, but instead of it being foreclosure situations or distressed sellers, it's just somebody who happened to have qualified for one of these loans. Now,
Mhm.
remember I told you there were certain caveats and you have to qualify for these loans?
Yes.
Yeah, well, one of them is, I told you about the fees with the 0.8% yearly for FHA and 0.5% one time for VA. But if
Okay.
you are a person who got a veteran's loan, a VA loan on your mortgage, I mean, you got
Mhm.
a VA mortgage on your home, and you are looking to have somebody else assume that. This is
Right.
a little known caveat here, but if you're looking to have somebody else assume that, you can sell it to somebody who's not a veteran or who's somebody to somebody who is a veteran. But if you sell it to someone who is not a veteran, you may not be able to get another VA loan for
Oh.
yourself until that loan is paid off.
Oh, that's a good thing to know.
Yeah. So, people are getting very creative with these kinds of things. That might be worth doing if you have an agreement with somebody that they're going to assume your mortgage and pay it off in full in 3 years. And if they don't, you know what I say about real estate deals, you can put anything in a real estate deal that you and the other party can agree to. So you
Mhm.
could say something like, look, I'm not going to be able to get another VA loan, but I'm all right with that. I'm gonna move into an apartment for a few years or whatever, but you must pay this mortgage off. You must refinance this mortgage and have it paid in full one way or another in, let's say, 3 years, or
Mhm.
else this happens, right? Or else, you have to pay me a bunch of money or whatever. You can make anything you want in a deal. Some
Mhm.
people have gotten very creative by saying, "Look, I know I'm the buyer and I wanna buy your home with the assumable rate mortgage. And you've got people who want to buy it with traditional rate mortgage, but my offer is good. Maybe I'm offering a little bit more money, or maybe I'm offering better cash down or whatever, but
Mhm.
you're leery of selling it to me because you think this assumable rate mortgage uh, lender will drag his heels and it'll take, 90 days to close this loan. And you don't want to wait that long, right?
Mhm. Yeah.
Well, then you might say to the seller something like this. You can choose anything you want, but here's just an idea. You might say to the seller, okay, but I feel really confident that this loan is going to go through. I've talked to the lender. I know I qualify. The house looks good. We've had, I don't think there's a problem here, but I'll tell you what, if it doesn't close in, say, 60 days, then I will pay your mortgage until it closes. Or I will give you X number of dollars more for the sale, or
You gotta
I will
offer a little
somehow,
incentive.
somehow I will sweeten the pot for you so that the seller says, well, okay, I guess my risk is pretty limited now. And I can
Right.
also call my lender and stay on top of them and say, hey, are you getting this loan through? Because I'm trying to sell my house here.
Yeah.
Um, but I think the sticky part there is that the lenders really do make less money on this than if they sold you a new mortgage. But I wouldn't let that deter me from looking for one of these mortgages. This is a lot of money that you can save yourself if you're really looking
Right.
at an assumable rate mortgage.
Okay, I was Googling while we were talking as well, and it says that the competitors of Rome are New American Funding, FHA Pro, and Assume List are the other
None of
two.
those are the one. So none of those are the ones I was thinking of. So that tells you how many are out there. There are many more. Yeah, and I think you're right. If you just Google this, you'll come up with them. I think there was something the founders of DoorDash or somebody.
Yes, I just was
Tony
reading
Sue.
that.
Yeah. So
Yes.
I mean, everybody's into it right now, and I do think the train is leaving the station here where it's going to become a hotter topic.
ClickUp, I'm gonna get it. ClickUp, Evernote, Notion, none of those, huh?
No, I don't remember.
right.
I'm sorry.
It'll be 2 a.m. and you'll be like, this was it.
Yeah, in fact, it was Rome Rome got like a $3 million investment from the people, Tony Zhu and
DoorDash.
that. Yeah, DoorDash, right, exactly.
DoorDash guy.
So
Yeah.
yeah, I'm sorry. It just it just escaped my memory, but whoever it was, you'll hear about him again, I'm sure. So I think, especially in our area, I think this is really important because, you know, I'm all for local lending and I'm all for people getting into their homes and all of that, but I just don't want people to overpay. And when you're talking about a 30-year mortgage or even a 15-year mortgage, but you're talking about, a 7% rate versus probably, between 2.5% and 4.5% on these assumable rate mortgages, depending on when they were taken out.
Yeah, it's hundreds of dollars of difference in your payment.
It is, and thousands of dollars of difference in your interest over the course of time. And so I hope, I hope that people hear this both on the buyer and seller side and understand this is something that they could look into and ask your real estate agent about it. And for realtors out there, if you're not familiar with these, maybe you've gotten into the game long after they were popular, please familiarize yourself with assumable rate mortgages because, boy, it could be a sales tool for you as well.
All right, well, let's get your phone number if anybody has any questions on this or anything else financial.
Absolutely. They can reach us at 413-773-3333.
And you can visit hugyourmoney.com for more, and we will talk again next week.
Great. Thanks, Jess.
All right, this has been Financial Fitness with the Money Doctor, Dr. Francis Ram on WHMP.